Hey everyone, this is Andrew, and today I wanted to go over what does a stock price represent? There's a lot of new people coming into the marketplace and they're kind of curious, but they're not really sure about what this means. What does a stock price mean? So on a basic level, if you take the stock price for a company and you take the number of shares outstanding and you multiply them together, you have the market capitalization. And again, the number of shares outstanding could be any number. It could be a million, it could be 10 million, it could be 10 billion. It's just the amount of shares that the company issued times the current stock market price for one share of the company. Then with the market capitalization, that tells you the overall value of the company. So if I was another company and I wanted to do a takeover, or if I was a private equity group trying to do a takeover, hostile takeover or something, I would use that price to know how much the company is worth. It's also important because if that stock wants to be traded in certain exchanges and certain indexes, there are requirements to be able to do that. And a lot of them have to do with market capitalization, also known as market cap. So for the S&P 500, you have to have a market cap of around 5.3 billion to be entered into that index. For the Russell 3000, this number changes sometimes, but right now it's around $153 million you have to be worth to be able to enter into that index. So you can see where the market capitalization is important there. But one of the mistakes I see a lot of people are making are, what does the price of the stock represent? And how do you tell if it's overvalued or undervalued? Well, first off, when you have a share of a company, if you own stock, you're owning the future profits or cash flows of that company. That's what you're doing here. You're trying to, it's different than if you go to a casino and you get a ticket and you either win or lose. No, this one is actually giving you a stock certificate and it's entitling you to the future profits of the company. Now, the way you value a stock is actually you take the present value of those future earnings. You bring them back to today, to the present value, and that's how you value a stock. So you can't just tell by a stock price, is it overvalued or undervalued? And also, different markets trade differently with stocks. In the United States stock market, we have these stocks that trade at huge value, well, huge nominal values or price per share. Then we have what's also known as penny stocks. So penny stocks trade for $5 or less per share. And usually those are companies that they're not even traded on the normal exchanges. They're traded on the OTC over-the-counter exchanges, which used to be known as pink sheets, and they have a lot less liquidity. If you're a new investor, if you're going into those, you want to stay away from the OTC stuff and you want to go into the more kind of standard investment style companies, which are usually market capitalizations that are much higher than what's traded on the OTC markets. In the US, you also have something where if a stock is trading around $10 or less, it's usually there for a reason. It's not just that the company was doing well and the stock price is around that amount. Usually the companies get beat up and then their stock price goes down to below $10 a share. So if you look at some things in some companies in recent history, you have companies like General Electric and Ford that once traded at high nominal values on the share price and are now under $10. I mean, General Electric used to be the largest market cap company in America. I think it was either like 300 or $350 billion. And now you have Apple and Microsoft and, well, Apple I think is at $2 trillion market capitalization right now. So GE has gone down so much in value that the stock now trades under $10 a share. Where that is in the future, we don't know. But the point is that it got beat up and that's why it trades lower. Most stocks are $10 and up that are considered like good investment stocks. In other countries, that's a little different. Europe actually has these major companies that the stock will trade at, single digits or low double digits, and it'll still pay a dividend and everything. It'll be a blue chip stock. It'll be a normal everyday kind of company. That's not the same here. It's a little bit different. An important thing to look at now, when you're looking at these stocks that have really high price per share, let's say Berkshire Hathaway, that's Warren Buffett's company, that trades at over $300,000 a share for a single share. There's not many people in America that could even buy one share of that company. Then you have other companies. You have Amazon that trades up there. You have Bookings Holdings. You have Cable One. You have NVR. You have Seaboard. So all those companies trade at $1,000 or several $1,000s a share for the share price. So if you just look at that, you would think that that's pretty expensive, but you're getting ahead of yourself here. The actual nominal value on the price per share does not indicate if it's overvalued or undervalued. On the other side of this, you have the penny stocks that I was talking about. So if you have, let's say, Aurora Cannabis, FSD Pharma, Shift Pixie, Property Insurance Holdings, if you have these penny stocks, they're traded at very low, $1, $2, $3 a share. Does that make them better than the higher price per share stocks? I mean, somebody would think, oh, if this one goes up to $100 a share, I would make so much money. This one would have to go up so much to make a lot, But you have to look at it by the percentage increase. Amazon going up $2,000 a share to $3,000 a share is a lot bigger than these smaller stocks, which will go up from $1 to $1.05 or something like that. That's why it's important to look at the percentage change when there's increases or decreases in the stock, rather than just if it goes up $5 or down $5. I think that's one thing that's very important that a lot of people kind of don't look at. Another thing is that to see if it's overpriced or underpriced, there are a couple different formulas and techniques people use to do that. One is the price to earnings multiple, the PE ratio. So to do this, you take the price per share and divide it by the earnings per share. And that gives you a number which you can relate to the other companies in that industry. So if you're in the tech industry, something will be trading at a certain multiple, and you can look at your company that you're investigating versus other companies to see if the PE is higher or lower. There's also two different PE ratios. There's TTM, which is trailing 12 months. And that gives you kind of the historical information, but we don't care about the history right now. I mean, if you want to look at that, that's really just to see if it breaks out of the trend of what it's been doing historically. What we want to look at is forward PE. So that takes the stock right now, looks out into the future, and analysts give estimates on what they're going to earn in the future. That's the PE that we want to look at, because we care not where a stock has been, but like what it's going to do in the future. Is it going to go up or down, right? So that's one factor you can look at. And you have to keep in mind that different industries trade at different multiples. If you're in like retail, or if you're in transportation or mining or something like that, your multiple per share is going to be different than if you're in the tech sector, where some of those things trade way up there on the PE multiple. There's also a lot of tricks that companies use to kind of pull one over on you so that you can kind of mess with the PE ratio. And a lot of people start using these other important formulas that they can kind of give them a better sense of if it's overvalued or undervalued. One of those is called the PEG ratio, PEG ratio. So what the PEG ratio does is it basically takes the price to earnings, and then it looks at the growth rate over the next 5 years, and it gives you a factor on that's, if it's 1 or less, that's considered undervalued, but it usually doesn't get below 1. The closer it is to 1, the better it would be. If it's above 1, the further above 1 it is, the more overvalued it would be. You're paying so much for that extra for those earnings, for that $1 in earnings. So that's another important kind of tool that people use to see if a stock is overvalued or undervalued. One more thing you can look at is also the return on equity. So if you're doing a real estate deal, you want to know your return on investment. If it's under 10%, you wouldn't even do the deal because it's not worth your time. Well, return on equity basically sees how well management at a company takes the amount of capital and all of their assets that they have, and what kind of return they are getting on that capital and assets. So that's important because it's basically your return on investment, return on equity. So that can give you an idea. Usually if it's 10 or lower, that's no good. If it's around 14 or higher, that's a good indication that the company is using their assets well. So there's a number of those different things there, and I think that's an important factor that you have to look at when you're looking at the share price. People try and go into these penny stocks and they're going to try and do day trading and they're going to lose all their money. And you have to see kind of what's the bigger picture with the stock price per share. What does it represent? Is it overvalued, undervalued? You can't just look at a stock price and say if it's overvalued or undervalued. You have to do the different methods that we had discussed here. So I hope that gives you a little bit of a background and some information on this. And from there you can do your own research and you can also find out additional formulas that you can use. But this is just an introduction for now. So thank you for watching. Hope you enjoyed it.